Did you know that over 70% of Americans live paycheck to paycheck? That's a staggering number. Most people think saving is the key to wealth, but here's the truth. Those who take risks often end up richer than those who play it safe. In fact, the stock market has historically returned about 7–10% per year, while the average savings account barely offers 0.05% interest. With inflation eating away at your money, saving can actually lead to losing value over time. Think about this. If you invested just $1,000 in the stock market 30 years ago, it could be worth over $17,000 today. But if you put that same amount in a savings account, you'd have less than $1,500. This is the power of risk and investment. In this video, we'll dive deep into why risk takers thrive financially. We'll explore the comfort trap of saving, the psychology behind wealth, and the strategies that can turn losses into gains. Plus, we'll discuss how flexibility can lead to financial freedom faster than you ever imagined. Are you ready to unlock the secrets of wealth that most people overlook? Let's get started on this exciting journey into the world of investing. Chapter 1. The Comfort Trap. Why playing it safe costs you big time. Many people think that saving is the safest way to build wealth. It feels secure, but in today's world, playing it safe can be one of the riskiest decisions you make. Holding on to cash in a savings account can actually cost you. Here's why. Inflation eats away at your purchasing power. In the US, inflation has averaged around 3.1% over the last 20 years. Meanwhile, the average savings account yields less than 1% interest. So, each year, your money is losing value just by sitting there. For savers, the real risk comes from missing out on bigger opportunities. Take this for example. The stock market, despite its ups and downs, has historically returned around 7–10% per year on average. Over time, that's a massive difference. If you saved $10,000 at 1% interest, after 30 years, you'd have about $13,500. But if you invested the same amount with a 7% return, you'd have over $76,000. This gap is why risk takers get richer. The biggest risk of all is not taking one, said Melody Hobson, president of Ariel Investments. She's right. Playing it too safe means watching your potential wealth slip away slowly. Savers also fall into the comfort trap. They feel secure with a steady balance, but they're often too fearful to step into more profitable ventures like stocks, real estate, or entrepreneurship. Chapter 2. The Psychology of Wealth. How risk shapes your mindset. Wealth isn't just about money. It's about mindset. Risk takers develop a completely different approach to money. They embrace challenges and uncertainty, which in turn builds resilience. This mental toughness sets them apart from savers, who may shy away from uncertainty. According to Daniel Kahneman, a Nobel Prize-winning psychologist, people are generally more sensitive to losses than they are to gains. It's known as loss aversion, and it stops many from taking risks. However, the most successful investors, like Warren Buffett and Ray Dalio, understand that managing risk doesn't mean avoiding it. They take calculated risks, using data and experience to guide their decisions. This mindset shift is crucial. Those who invest in higher risk assets develop a tolerance for short-term losses, which leads to long-term gains. Risk takers also think big. They focus on growth, while savers often concentrate on preservation. This difference in perspective has huge consequences. Entrepreneurs, for instance, know that the bigger the risk, the bigger the potential reward. Amazon's Jeff Bezos once said, "If you want to be inventive, you have to be willing to fail." And fail he did, countless times, but he's now one of the richest people in the world. Chapter 3. High stakes, high rewards. The power of compounding. With risk, compounding is one of the most powerful tools for wealth creation, and it works best when you're willing to take risks. Albert Einstein called compound interest the eighth wonder of the world. But here's the catch. The more risk you're willing to take, the more compounding can work in your favor. Let's compare stocks to savings. A $10,000 investment in the S&P 500 in 1993 would have grown to over $92,000 by 2023. That's nearly a 9x return in 30 years. Meanwhile, if you'd kept that same $10,000 in a savings account, it would have barely grown at all. The stock market's long-term returns, despite volatility, beat savings accounts by a mile. This is the power of risk and compounding working together. Here's a unique fact. According to a study by the Boston College Center for Retirement Research, households that invest in stocks typically accumulate 7-10 times more wealth than those that stick to savings accounts or low-risk bonds. The data is clear. Risk-taking is a key driver of wealth. But it's not just about buying any stocks. Risk-takers understand the value of diversification. They spread their bets across a range of investments, reducing the chance of a big loss. For example, an investor with a diversified portfolio can handle a bad year in the stock market because they might also have real estate, bonds, or even crypto that perform better in that period. This is how they manage risk while maximizing their potential for reward. If you find this information valuable, don't forget to subscribe. Stay tuned for more insights and tips on how to build wealth through smart risk-taking. Chapter 4. The Portfolio Gamble. Building a balanced but bold investment strategy. Creating wealth through investing doesn't mean going all in on risky assets. Successful risk-takers are smart about diversifying their portfolios. They blend risk and safety to protect themselves from big losses while still aiming for big gains. The key strategy here is to balance between aggressive and stable investments, a method known as asset allocation. According to Vanguard, proper asset allocation can account for up to 90% of a portfolio's performance over time. For instance, many investors use the 60-40 rule, 60% in stocks and 40% in bonds. But risk-takers often tweak this balance depending on their goals and timelines. Younger investors might go 80-20 in favor of stocks, taking on more risk for higher rewards. The idea is to be bold when you can afford to and pull back when necessary. Warren Buffett, one of the most successful investors of all time, famously advises, "Be fearful when others are greedy, and greedy when others are fearful." This quote reflects the mindset of risk-takers. They don't follow the crowd. When markets are down, they see opportunity. When they're up, they stay cautious. Another part of building a balanced but bold portfolio is embracing alternative assets. Risk-takers might invest in startups, cryptocurrencies, or even real estate crowdfunding. These assets can be volatile, but they also offer potential for outsized returns. For example, Bitcoin, despite its wild price swings, grew more than 200% per year from 2011 to 2021, far outpacing traditional assets. Still, risk-takers don't just gamble recklessly. They always have a safety net. Many use bonds, dividend-paying stocks, or index funds to create a base of stability. These lower-risk investments offer steady income and act as a cushion during market downturns. It's this mix of high-risk, high-reward assets and safer bets that gives their portfolios a healthy balance. Chapter 5. The fail-forward formula. Turning losses into gains. Risk-takers don't fear failure, they use it. Every successful investor or entrepreneur has lost money at some point, but they see failure as part of the learning process. They adapt, adjust, and come back stronger. This is the concept of failing forward. It's not about avoiding losses altogether, it's about learning from them and turning those lessons into future wins. One of the best examples of failing forward is Elon Musk. Before Tesla and SpaceX became massive successes, Musk went through a series of expensive failures. His first few rockets blew up, and Tesla was on the verge of bankruptcy multiple times. But Musk kept pushing. "If things are not failing, you are not innovating enough," he once said. In the world of investing, this mindset is just as important. Markets will always fluctuate. Sometimes, you'll lose money in a trade or an investment will underperform. Risk-takers don't let that stop them. They assess what went wrong and adjust their strategy. Data from Dalbar's quantitative analysis of investor behavior shows that the average investor's returns are about 4% lower than the market because they panic during downturns. Risk-takers, on the other hand, often hold their ground or even buy more during a dip. Another strategy for turning losses into gains is tax loss harvesting. This is where investors sell losing assets to offset gains in other areas. It's a smart way to minimize your tax bill while keeping your overall strategy intact. It's not just about making money, it's about being strategic in how you handle both gains and losses. If you found this video valuable, make sure to subscribe for more insights on how to create wealth through smart risk-taking. Let's continue this journey to financial empowerment together.